and welcome to BloombergQuint. The US Federal Reserve has given its strongest signal yet. The taper will begin somewhere in this year, with Chair Powell saying that he too was in favor of that scenario. He, however, did not give a timeline and also drew a very clear line between tapering and raising of interest rates. The bar for the latter, he said, is much higher. Joining us to help us think through what taper, when it comes, will mean for emerging markets in India this time around is Suyash Choudhary, Head of Fixed Income at IDFC Asset Management. Suyash, thanks so much for taking the time to speak to us.
Thank you so much, Ira. Pleasure to be here.
Okay, let me just start first by getting your sense of what you picked up from the much-awaited Jackson Hole speech of Chair Powell. The markets seem to have come away with a view that it's a dovish taper, whatever that means.
So, what matters ultimately for global markets is whether their expectations with respect to the future of policy normalization are getting met or not. And there, to the Fed's credit, this time around, the messaging is very adequately flagged well in advance. And, like you noted, there is a distinction between taper and the actual raising of rates. So the Fed has, in fact, been preparing the market for some sort of a taper to begin. Although timelines on when this begins have been slightly divergent amongst market expectations, but nothing materially. And the Fed chair's speech did not throw any adverse light on this expectation. The other aspect, which probably soon will gain more prominence, is the current market's expectation of peak policy rates in this cycle, and when actual liftoff begins from the Federal Reserve, and the Fed's own thinking on that. And the big dovish messaging from the Jackson Hole speech was, in fact, this, that there is a very large difference between the taper actually happening, which is linked to substantial further progress on employment and inflation goals. And the chair noted that inflation goals, that progress has been, in fact, made, and the actual liftoff, which is linked to the Fed's assessment of full employment and inflation being at 2% and well on course to modestly exceed 2%. So as of now, that expectation remains intact, that the Fed lifts gradually, and that the peak policy rates in this cycle will be somewhat lower than that in the last cycle. Now, in subsequent Fed meetings, both these points will be of relevance. One is the taper schedule, which probably is more a near-term phenomenon. But as, let's say 2024 dot plots start to reveal themselves in Fed meetings, the market will also get some sense on Fed's thinking on the more medium-term policy rates in this cycle. And like I said, we think that will gain more prominence as far as market reaction function is concerned in the days ahead.
And I'll ask you about the sort of thinking behind that in a minute. But in terms of sort of the taper process, can you help us with your thinking on how that starts to play out for EMs in terms of capital flows, EMs and then India? What are the determining factors to your mind?
So EMs, as we all understand, are no longer a homogeneous basket. So previous attempts to, basically club them in some sort of a parameterized, constant have actually not worked out. Now, to India's benefit this time around, there are quite a few factors that are noteworthy. And, one can draw comparison from 2013, but frankly, it's a bit of an irrelevant comparison. But just to, throw things in sharp relief, probably, that's narratively useful. So one, this time around, India is not hyper-stimulated from policy. Right, so we, broadly, people believe that the last year's and this year's fiscal stimuli have been reasonably nuanced. That RBI policy, although proactive, has, for all the noise it has generated, largely progressed if you see the balance sheet. So neither has the balance sheet expansion been extremely aggressive, nor has it, lost touch with convention to a very large degree. So, for example, most of the accretion over the last 12 months has been via the FX reserves growth, which is obviously good as far as an EM is concerned. So policy has not been overly stimulative, and that is reflected in one, that we are taking time to achieve pre-pandemic growth, and second, current account is largely well behaved, which is the number one susceptibility that in a global volatile environment and emerging market quotes. The second aspect, to also remember is that unlike previously, FPIs for debt have actually been quite agnostic of India for the last 3-4 years. So it's not as if they have recently been building a very large position that would be subject to some sort of misfooting. The third aspect is that both at a micro and macro level, there are a lot of levers that India is currently exercising to draw global capital, some of which are fructifying more at micro level. So if you look at company level, both debt and equity as well as FDI kind of money flowing in. And at macro level, hopefully with the disinvestment program now gaining speed and the asset monetization or temporary leasing of asset program also getting underway. So, there is a capital draw that is also in play, although that doesn't take away the primary mandate that current account deficit should be well behaved. And fourthly, the starting point on FX reserves is quite decent, although this is the weakest point in this argument, because for emerging market, it's the flow of FX that would count more, not so much as where you started from. So to clarify, you're starting at $615 billion, but suppose you start losing $50-60 billion in a short period of time, that would be of concern. Not that that is likely to happen, but that's the weakest point in this four-part argument. But primarily, it is to do with the fact that we are not overstimulated. We are gradually gaining ground back to pre-pandemic levels, and FPIs on debt have anyways been agnostic for some time.
True. What, if anything, do you make of sort of the growth differential, story? Because you will have a scenario in which advanced economies will be growing, at a very fast clip, and that sort of growth differential that always brought capital in favor of emerging markets, India, may not be as stark as it has been in the past. Does that play into this future period of taper and normalization of policy from the Fed?
So, why one way this cycle has been quite notable is that the economic realities at major blocks around the world are actually very different. So, in a normal boom bust cycle, you would see, a bust being followed by revival, and typically emerging markets reverting to trend more quickly. And, that is how the process runs in a largely synchronized fashion. Now, obviously, there is some amount of synchronization in this cycle as well. But for example, take the case of US, which is where the fiscal exceptionalism has been the highest. And in fact, US is the system which has kind of reset the way you analytically think about the world right now, because they've gone ahead and given 25% of GDP as a fiscal stimulus spread over around 1.5-2 years, which has led to a scenario where, over 2021, their growth rate is probably 4 times their long-term trend rate of growth. And over 2022, it will be roughly 2 to 3 times their long-term trend rate of growth, which is quite unprecedented, and which is why it has kind of, if you were to call it, upset the global analytical thinking apple cart in some way. But if you examine, and this is now quite speculative, but if you examine the US fiscal stimulus in greater detail, bulk of it is a very short period expansion aimed at revenue spending. Right, so it is basically some sort of fiscal transfers to households, which by definition has very weak multiplier effects on growth down the line. So, in the Indian context, the RBI has put out studies in the past, basically saying that revenue spending has very short multipliers of less than 1 year. Capital spending has stronger multipliers and more persistent multipliers. So if you apply a similar framework to the US economy, most of this spending would probably have very weak growth multipliers. And also a significant portion, as we know now, is getting saved or used for deleveraging, which is amounting to the same thing by households. So you wonder, although this year and next year growth profile is going to be quite robust, whether the debt being taken is commensurate to adding to the long-term potential growth rate of the system. Right. So what, in other words, and more simply, it means is that at least to us, there is a reasonable probability that by late 22, early 23, the US system would have probably run out of a substantial portion of this fiscal fuel. Now, obviously, on the other side, you may argue that fresh stimulus is being talked about, which is now aimed at infrastructure and therefore will have stronger growth multipliers. But to be fair, those are being planned over longer periods of time. And the net stimulus spending there is weaker, because a lot of that will be financed by the budget, through some other measures. So, although today the growth rates of the developed world seem overwhelming, we are cognizant that a lot of it comes through a short burst of very large fiscal spending, which probably has lower growth multipliers. And the situation, let's say in 2023, may look quite different. So, what we worry about, if at all, is in the short run, can the market expectation get dislocated with respect to where the medium term rate hike cycle is going to peak? Although we don't think it's very likely, but that's a tail risk. But we are more confident that as you step into late 22, you will probably realize that most of the multiplier effect of this spending has faded out, and therefore the growth differential related EM flow probably is a short term headwind. And like I noted before, India has some micro stories playing for them, which are good draws for capital for India. But over the medium term, I don't think the growth differentials have been meaningfully reset. At least that's our current hypothesis.
On the debt side, as you mentioned earlier, we haven't, we've had a few years of very, very tepid flows into debt from the foreign investor community. So, the reversal story may not play out. However, the potential of flows coming back into India also remains relatively timid at this point in time, not just because of what's happening globally, but also because we are continuing to, work on a negative real interest rate kind of story. So there's really no reason for debt flows to come back in a big way.
Well, yes, I agree with the, with the conclusion that you're drawing. I have struggled to figure out why. Okay. Because see, this real rate story, in fact, so why have debt flows not been coming since 2018?
Yeah.
Right. In that 18-19 period, even at a policy rate level, if memory serves me correctly, we were very reasonable on real positive rates.
Yeah.
Today, let's say the 5-year benchmark. So remember, our yield curves are very steep. Right. So at the policy rate level, and assuming a long-term inflation in India is 5%, at a policy rate level, you can argue we are deeply negative. But at, let's say, the 5-year government bond point, we are probably plus 75 basis points. Whereas the US is somewhere in the vicinity of 150 or 175 negative. Right. Yeah. So at the 5-year point, you could potentially argue that rate differentials are fine. Although I don't, understand how, this has driven capital flows into fixed income over last few years as well. Because, we had the best of real positive rates for 3 or 4 years on trot. But that doesn't seem to have sustainably changed the narrative on inflows into India. Now, the bond market, any which ways, is not expecting anything. The only, one eye out people have on is for a push factor to materialize, which is something like an index inclusion. But again, nobody expects that to meaningfully happen this year. So as far as the bond market is concerned, it continues to look to RBI for being that buyer that, kind of balances the demand supply gap for the bond market.
Sure. Suyash, just coming back to sort of more immediate concerns, market-driven concerns. So I think a few months back, there was real worry of rising US yields, what that would mean in terms of, sort of implied tightening for, economies before they were ready for it. That has, in a sort of counterintuitive way, eased off as we get perhaps closer to taper. What's your thinking on that and how that moves forward, and also then the implications for the dollar?
So that's, always, and, always we get to appreciate that in hindsight, including ourselves. So most of the market, but markets are very forward looking. So in fact, the peak policy rate expectations in the US peaked out somewhere in March and April. And since then, if you see how much rate hike expectations people are building, let's say in 2023, that has stagnated to fallen, and then it kind of bounces around a particular point. If you see bond yields, they seem to have peaked out over there. Probably it has to do with, one, the forward discounting mechanism of the market, and second, because data itself has started to turn out slightly more mixed compared to the elevated expectations of the market. So it's always about, actual versus expectation, and market had very, very lofty expectations with respect to US data, and, recent data has been more patchy and mixed. That is not to say that we cannot have another reset shock, right? And like I said before, if there is one tail risk that we worry about, it is that probably a mix of data reopening or inflation persistence for a period of time leads market to believe that the peak rates in this cycle are probably going to be higher than what is being discounted currently. And if at all there is potential for chaos, it is from there. And again, this is not a base case, to clarify. It is a tail risk that we continue to think about from time to time. So, one hopes that the next 3 or 4 months progress in a direction where, market expectations don't get significantly nudged upwards with respect to peak policy rates in the cycle. Like I said before, we are more convinced that by late 22-23, we will have more evidence that indeed peak cycle rates are going to be lower in this cycle. I mean, again, it boils down to the nature of the stimulus. The fact that if a large amount of debt is taken and rooted into low multiplier spending over a longer period of time, that is fundamentally, it takes away from growth or long-term potential growth rather than adds to long-term potential growth. So we would, with the evidence available so far, believe that long-term potential growths probably have somewhat notched down for most of the world. And therefore, peak rates in the cycle will also be probably slightly lower. But the next 3 or 4 months are important. And the biggest relevance, like I keep saying, will be whether it nudges markets' peak rate expectation higher or not.
So most of your thinking on peak rates is emerging from this nature of fiscal stimulus being more revenue spending and hence its implications for medium-term growth. On the inflation side, is there thinking on whether some of this supply side inflation becomes entrenched, leads to inflationary expectations, wage price spirals, etc.? Is that a risk as well that you're watching out for?
You mean in the case of the US?
In the US, yes.
Okay. So, so just look at some of the factors that the Fed chair pointed out in his Jackson Hole speech. So first, with respect to inflation currently, which is roughly running around 2 percentage point higher than 2% long-term goal. So he says that around 1 percentage point is being contributed by durable goods, which in fact have been stagnant inflation-wise for a very, very long period of time. It's only now that they're showing signs of life. So as a Fed chair who very well knows that, and he observed this in the Jackson Hole speech also, that whatever rate hikes they implement now or whatever tightening they implement now will actually impact the economy with a 1-year-odd lag. How do you react to durable goods inflation when you have data in front of you that they actually have been stagnant in price rises over the last many, many years? Secondly, he says, if I remember correctly, some 0.8% is contributed to by fuel, right? And then he talks about some basis points because the price fall effect has kind of filtered out of the 12-month readings, whereas the price rise effects are all there. Then he talks about longer term inflation expectations. So if you see 5-year forward in the US, it is kind of bouncing around, if I remember the number correctly, in the 5 to 10 area, right? So it's not very different from where it has been in previous years as well. So it's not as if there is a traded expectation that is significantly ratcheted up over the long term and the Fed is ignoring that. Right. The counter view obviously is that if you look at companies, they are complaining of people shortages. They are complaining of input cost pressures. Rental inflation people worry about. So it's not to say that there are not arguments on the flip side, as we very well know. And the Fed is trying to, in all fairness, hedge themselves, saying that if price pressures were to prove more durable, they will act on it. But it's very clear that their analytical thinking is leaning towards the fact that these are more, or towards the notion that these are more temporary in nature. And frankly, some of the points that they put out are persuasive. The only thing that, at a very 30,000 feet level that does not reconcile with us is that if an economy grows 3x their trend rate of growth, will they not see inflation pressures? And indeed, they are seeing inflation pressures. So probably how we reconcile this with the long-term inflation expectations is our own thinking is that by 2023, the economy would probably have slid back into long-term trend rate of growth levels, and inflation therefore would have started to come off, which is why the 5-year inflation expectations are reasonably high, but 5-year forward are more well behaved. So probably that's consistent with the way we are thinking as well.
Last question, Suyash. I mean, you already spoken about one tail risk which could emerge from, sort of the peak rate expectation in the market changing. What are the other event risks, or you see? I guess the pace of taper, the timing would certainly be, one obvious factor. Are there policy mistakes? That either on not so much on their side but on our side, which could sort of precipitate a worse experience of a taper tantrum this time around than we have seen or than we are anticipating right now.
So the base case remains that there is no taper tantrum, but just to kind of examine tail risk scenarios. So see, in the case of India, and obviously monetary policy has done a remarkable job. They have been analytically very clear through this phase. They have dispensed with data interpretation issues that have cropped up for the market from time to time, and so far they have been proven right. Now, if at all, you can, the way we would think about is that the overnight rate is at an emergency level. Right, and analytically, you can think that even if there are further growth risks on the anvil, is it fair to continue to keep overnight rates at an emergency level that typically corresponds with unmodelable, huge downside tail risks to growth? Now today, most things are becoming more modelable, and probably in the realm of statistical significance, we can dispense with very large tail risks to growth. So, whether the 3.35 overnight rate is threatening to overstay its welcome is one, way that one has to seriously think about. But at the same time, the yield curves are quite steep. And probably, the next leg of RBI framework development has to be of how the reversal will progress, right? So, for example, in his last available interview, the governor has refused to speak about it because, he says that why do you assume that we are on the brink of reversal, which is fair, right? But if you want to keep market expectations anchored when you take the next step, you need to be able to communicate before that next step what your reversal schedule is going to look like. Otherwise, the risk is that the market overreads into your relatively benign next step. As, for example, what happened when the VRRs were first announced again this year, right? So whenever that next step comes, probably it comes in the October policy through. So one thing that they have done is they have delinked VRR from a normalization endeavor. Right, so the governor was very clear in the policy statement that don't mistake VRR as any attempt to normalize policy, which is a very welcome clarification for the market. But because there is a number of steps that will need to get taken before you actually are in the realm of repo rate hikes. So you have already started to basically de facto step away from yield curve control, and you are back to orderly evolution of yield curve, which is being seen in gradual bond yield rises. You have expanded the amount of VRRs. Now, one question on market's mind is that you have, core liquidity in the vicinity of 11 lakh crores. So how will your normalization run? Will it be just expansion of VRR in quantum as well as tenure? And then you can at some juncture start to hike the reverse repo rate? Or you are going to take durable steps to remove liquidity. Obviously, nobody expects OMO sales to the market, but something like, MSS bonds or something like that. So the question really in markets or in RBI's mind to us would be that when the next step is taken, there is a risk that market overreads that. And therefore, one has to lay out that framework well in advance. And the other point, that is 335 overstaying its welcome in some sense. Because remember, I mean, a bank is raising money at 385, 390 for 1 year today. Housing finance and non-bank finance companies are raising at 430. Now, reasonably, whether that amount of accommodation for such balance sheets is required or not is something that one can always argue for. So we are in the realm of nuance, right? And obviously, policy needs to continue to be accommodative. Obviously, we need to gently flatten the yield curve as the overnight rate starts to rise. And for those things to happen, a schedule or an analytical framework of how normalization would proceed is probably something that the RBI should now start to think about to manage the signaling effect of whenever the next step is taken.
All right. Got it. Suyash, thank you so much for your time. Thank you for explaining to us the global picture, how the local picture plays out as well. Appreciate your time here on BloombergQuint.
Thank you so much.
Thanks for watching.